This week, Microsoft stock did something surprising. While the broader market stumbled and other tech giants fell, Microsoft climbed. The rebound comes as the company finds itself at the center of a growing storm of legal and regulatory challenges. A new lawsuit alleges its AI tools caused severe mental health harm, and regulators in Japan are investigating the company for potential monopoly abuse. So why did investors rush into the stock when headlines seemed so grim? Welcome to TickerWatch News for Microsoft, Week 10, 2026. This is your weekly look at the news and financial developments for Microsoft. It was a week of divergence for Microsoft's stock. The share price began the week at $392.74 and closed at $408.96. That's a gain of over 4%. This performance stands in sharp contrast to the broader market. During the same period, the Dow Jones Industrial Average fell nearly 3%, and the S&P 500 was down almost 2%. Other members of the Magnificent Seven tech stocks, like Apple and Alphabet, saw their shares decline. The takeaway is that Microsoft acted as a safe haven for investors, who appeared to rotate back into established software names amid wider market volatility and tariff fears. Microsoft was at the center of several major headlines this week, spanning AI safety, regulatory scrutiny, and shifts in its core gaming business. First, the company and its partner OpenAI are facing new legal challenges over generative AI. A lawsuit filed in San Francisco alleges that ChatGPT caused severe mental health harm to a user, claiming the companies released the technology with insufficient safeguards. This is the first case to directly target both companies for alleged psychological trauma linked to AI use. The suit seeks damages and legally enforced changes to AI safety protocols, putting a spotlight on product governance and liability risks. Second, Microsoft is facing new antitrust pressure, this time in Japan. The Japanese Fair Trade Commission raided Microsoft's Tokyo offices over suspected monopoly abuse. The investigation is reportedly focused on whether Microsoft used its dominant software position to unfairly steer customers towards its Azure cloud platform and away from competitors. This action adds another regulatory challenge to the company's global operations. Third, there was a significant leadership change in the company's gaming division. Phil Spencer, the CEO of Microsoft Gaming for many years, is retiring. Asha Sharma has been appointed as the new CEO. Sharma previously served as an executive at Meta and Instacart, bringing a background in scaling large consumer-facing products with a focus on AI. This move comes as Microsoft continues to integrate its massive acquisitions of Activision Blizzard and Bethesda, signaling a potential strategic shift for its Xbox and Game Pass ecosystem towards a services and platform-oriented future. Finally, in the AI partnership space, Microsoft offered some clarity regarding its relationship with Anthropic. After the Pentagon labeled the AI startup a supply chain risk, Microsoft confirmed that its customers will still have access to Anthropic's AI tools, including its Claude models, for all non-defense applications. Microsoft's legal team reviewed the designation and concluded that its commercial and non-defense work with Anthropic can continue across platforms like Microsoft 365 and GitHub. Investor sentiment around Microsoft appears to be a mix of bullish conviction and cautious observation. The stock's 4% rally this week, even as the broader market fell, suggests a rotation into what some analysts call defensive tech names with resilient business models. One David Davidson analyst described Microsoft's Windows and Azure platforms as stay-connected necessities that businesses will remain committed to even in an economic slowdown. Wall Street analysts are divided on the company's path forward. Jefferies reiterated a buy rating with $675 price target, highlighting Microsoft's strong position to capitalize on corporate AI spending. Goldman Sachs also gave the stock a buy rating. However, other firms are more cautious. Melius Research and Stifel both downgraded the stock to hold, expressing concerns that heavy capital expenditures on AI infrastructure could pressure free cash flow and that earnings estimates for fiscal 2027 might be too optimistic. This split view reflects a central debate. Can Microsoft's AI investments generate enough profit to justify the massive cost and growing risks? From a technical perspective, Microsoft's stock showed notable strength this week, rebounding above the $400 mark to close at $408.96. This positive move happened while the S&P 500 experienced losses. Despite this weekly gain, the stock is still down about 15% year-to-date in 2026, having corrected from a high of over $550 in late 2025. This recent bounce from a lower base is a positive signal for investors. On the fundamental side, the narrative is a balance of growth and risk. The growth story is driven by AI, with Microsoft's cloud revenue recently crossing $50 billion in a single quarter for the first time. However, this growth comes with a hefty price tag. The company's capital expenditures have been significant, with plans to spend as much as $200 billion on AI infrastructure in fiscal 2027. This spending has raised concerns about near-term pressure on cloud margins and free cash flow. Valuation metrics suggest the stock may offer value, with one report noting its price-to-earnings ratio of around 23.5 is roughly 25% below its 5-year average. Looking ahead, the key focus for investors will be any new information on the company's ability to monetize its massive AI investments. Upcoming earnings reports will be scrutinized for evidence that products like Microsoft 365 Copilot are converting into durable, high-margin revenue. Developments in the ongoing legal and regulatory battles will also be critical. Any updates from the ChatGPT mental health lawsuit or the Japanese antitrust investigation could impact investor sentiment and the company's financial outlook. For price levels, it will be important to see if the stock can hold its ground above the $400 level and build on this week's momentum. The bull case is that AI revenue growth accelerates and Azure continues its strong performance, justifying the high capital spending and helping the company navigate legal headwinds. The bear case is that regulatory and legal costs begin to mount, competition in AI intensifies, and the high spending fails to deliver expected returns, causing the stock to pull back. That's all for this week's TickerWatch news for Microsoft. The information in this podcast is for educational purposes only and is not financial advice. Thank you for listening. We encourage you to subscribe, leave a review, and share this episode.